Okay, we're going to now continue with the section on taxes, specifically personal income taxes. So let me go to where we left off. So in the previous video, I talked about the average tax rate, which is basically where you take your total tax and divide it by your total income, because that's essentially what you really are paying. But there's also something called a marginal tax rate, which is for every additional dollar, this is the tax that you're going to be paying, the tax percentage. And this is a good rate to know, by the way, because let's say, for example, you have an opportunity to earn overtime where you're going to be paid maybe at a higher rate by staying longer on the job, maybe beyond 40 hours if your employer offers that. Well, even though you might be getting paid more, it's also possible that you might be taxed at a higher rate. So it may not be necessarily the best thing to do, or at least it may not be as good as a deal as you're hoping for. So moving right along, when we're also talking about tax rates, we're talking about something called the filing status. And I did mention this to a certain degree earlier in our presentations. So there are basically 5 different filing statuses. A person who is single, and by the way, with each of these, the tax rates will vary. So there are single people, there are married filing jointly. And for this, you'd have to be married on the last day of the year to file a joint return. Typically, the tax rate is lower than it is for single people. Of course, too, when a joint return is filed, both taxpayers are liable for the tax. Most married couples file joint returns. They can file under other circumstances as well, but as you'll see from the next one. But most married couples tend to file a joint return. So again, in case you're wondering, this is where on every year you have to do a reporting of your income, and from that is when you it's determined how much you actually owe to the government, or owed. Maybe you're going to get a tax refund, so you owed a certain amount but had extra withheld. So that's why you're filing this tax form. There's also married filing separately. So each spouse will file their own separate return. And in some cases, it makes sense to do this. If you have one spouse who earns a very high income and another one who earns a very low income, sometimes when you do the numbers, it actually comes out better to file separate, married filing separate, because this way you wind up coming out with a lower tax. You have to do the number crunching in order to figure out which one is the right one. Next one is head of household. These are single taxpayers who provide a household for a qualifying person. This would be a dependent or a relative other than a cousin, somebody who's close in family, let's say an elderly parent or somebody like that. And then finally, a surviving spouse. So for 2 years after the death of a spouse, the surviving spouse may use the joint tax rates if they have a dependent child living with them. So the surviving spouse rate is important to understand, because if you have a married couple and one of the spouses dies, that person now becomes single. So as I just mentioned, married filing jointly has a lower tax rate than single people. So the surviving spouse filing status helps a little bit for the spouse who is still alive, because, and provided though that they do have a dependent child. So this way they will still file their taxes and pay under the joint tax return, at least for 2 years. compared to the single filing, which is going to be a higher tax rate. Okay, a couple other things here too. Take-home pay. You'll hear this term take-home pay. Well, the taxpayer's gross pay, which is, you say I earn $50,000 a year. Okay, well, that's your gross pay. And then you have deductions that come out. Your income tax, whether it's federal tax, state tax, local tax, Social Security and Medicare taxes, any employee benefits that you have, like health and life insurance, and any contributions to a 401k. So you deduct all of these things from your gross pay, and that gives you your take-home pay. So that's what actually gets either sent to you in the form of a check or is in the form of a direct deposit. And I'm finding that most employers these days will provide you with direct deposit. It goes right into your bank account. Okay, capital gains, capital losses, and dividends. So there are two types of capital gains. There are short-term and long-term. So a long-term capital gain occurs when you have held a property for more than 12 months. If you do that, you're going to be taxed at long-term capital gain rates, which is a lower rate than short-term capital gains. A short-term capital gain is you've held a property for less than 12 months and then sold it at a profit. Short-term gains are taxed at ordinary income rates. So in other words, whatever your regular tax rate is for your pay, for your salary or for your wages or commissions, whatever that rate is, that's ordinary income. So if you make a profit on something, some property that you buy and sell within 12 months, you're going to pay at the same rate as any of your other income. So it's good to know that if you can possibly wait a little bit longer and wait till a year has gone by, then you can pay at a lower tax bracket. So the long-term capital gains have reduced rates. And so the way that it would work is if you're in a 0% tax bracket, so that's your very low tax bracket. I'm sorry, your capital gains rates are as follows. If you are in a 10 or 12% tax bracket, you're going to pay 0 in capital gains. Well, that's really pretty strong. So you don't earn a lot of money. You're in a 10 or 12% tax bracket, and you make a profit that on something that has occurred, something that you've held on to for longer than a year. You don't have to pay any tax on that gain on the sale of that property. If, on the other hand, your tax bracket is 22, 24, 32, 35, whatever it is, then you pay only 15% on that gain that you earned when you sold your property at a long-term capital gain. Finally, if your tax bracket is at 37%, then you will only pay 20% on that long-term capital gain. It's a good deal. Now, also, dividends from, and by the way, dividends is a form of income that is paid if you own stock. Dividends from U.S. corporations from the United States, those are taxed at long-term capital gain rates. So that's a benefit there. Capital losses in excess of capital gains are deductible up to $3,000 a year. So let's say you sell something at a loss, and it's a big loss. Let's say it's $50,000. You can deduct from your income $3,000 and then carry over the remaining $47,000 for future use. You may be able to offset it with other capital gains and losses. But if you still have a net capital loss, you can deduct up to $3,000 from your income. Whatever still has not been deducted on that original $50,000 capital loss, you then move that over into the next year. So you keep doing that until ultimately that capital loss of $50,000 goes away. A corporation cannot deduct capital losses. So if we're talking about income from your employment or income from investments like stocks, bonds, mutual funds, exchange traded funds, which we'll talk more about later. If you have those type of income, those income may limit your deductions. In other words, what you're able to, what expenses you might have, what itemized deductions you might have, which we'll talk about in a moment, that may limit you depending on the kind of income you have. So under active income, which is income from personal sources and other non-investment income, that's called active income. Portfolio income is income from investments. So it could be any gains that you make on selling an investment or any dividends you get or interest from bonds. The amount will limit deduction of investment interest. So investment expenses are miscellaneous deductions which are not deductible from 2018 to 2025. Well, we really haven't talked about miscellaneous deductions yet, so I'm going to hold that thought for now. Another type of income, however, is passive income. This is income from property that's not related to the personal services of a taxpayer. So this, if you're not, this is not income from a job or from your portfolio of investments. This is called passive income. Where you really see passive income is when it's real estate. So real estate is like if you're renting a property, the rental income that you get is passive income. So you are not working like an employee is working. You have property that is producing income for you. So because of that, this is passive income. It is different from portfolio income because it has to do with the type of investments that you are making. So passive income, think really in terms of real estate. That's the one main way of considering passive income versus portfolio income or active income. So just remember that there are different types of income out there. All right, so taxable income is computed as follows. You have gross income, so it's all income from whatever source, less whatever is excluded by Congress. So if you have received life insurance proceeds, someone died and they named you as a beneficiary, then that is not taxable. If you received a scholarship or gifts up to a certain limit, that is not income. If you had bonds that were state and local bonds and you live in those states especially, then you don't have to pay income tax on those as well. So you subtract these adjustments to your income. And also if you have a business, any business expenses, any contributions you make to a retirement fund like IRAs or Roth IRAs, and any other tax deductions that are allowed. And this gives you your adjusted gross income. Adjusted gross income is an important number because a lot of times other calculations are based on that. So adjusted gross income is basically you take your taxable income, deduct all the different things that we just mentioned, things that are not taxable, things that are business expenses, things that are contributions to retirement funds, and that will give you your adjusted gross income. Moving right along. So you have the adjusted gross income. And then you take the lesser of the standard or itemized deductions. And the tax law has changed a few years ago. So now about 90% of taxpayers claim what they call the standard deduction. In 2017, it was 67% claimed standard deduction. So the difference then is your taxable income. You add back any tax credits that you have, anything that you paid extra into, and the difference is your tax liability owed. Now, if your brain is a little foggy right now from what I'm telling you, that's okay, because I'm going to at one point show you how these are calculated by using a tax form. I think that's the best way to look at this. So the thing to remember for now, though, is that there are really, when you're doing your personal tax return, you come up with your adjusted gross income. Okay, take your total income less any of the deductions that come out of there. That gives you the adjusted gross income. You then have a choice. The Congress has allowed you a certain amount that you can then deduct from that. That's your standard deduction. It's usually a certain dollar amount. But on the other hand, if you have certain types of expenses that are larger than the standard deduction, you are allowed to use what they call itemized deductions. And we'll talk more about that in a moment, but itemized deductions are involving things like taxes that you pay, interest that you pay for mortgages on a mortgage, charitable contributions that you make. So if all of these itemized deductions that I just mentioned, and there are a few more, if all these are larger than your standard deduction, then you use the itemized deduction from your adjusted gross income. Because what will happen is, remember, this is a form of tax avoidance. You are legally doing this, okay? Itemized deductions are permissible provided that they're approved by the law through the Congress. All right, so hold this thought: standard deduction versus itemized deduction. Okay, so let's look at what the standard deductions are. So let's go with the number in 2022, but we can also explain how it goes up in 2021. So as I said, when you have your adjusted gross income, you can deduct the greater of the standard deduction or itemized deductions. Standard deductions for taxpayers under 65, the amount depends on your filing status. So if you're single, in 2021, you could have deducted from your adjusted gross income, you could deduct $12,550. In 2022, you could deduct $12,950. And if you were over 65, it's $14,700. Now they're making adjustments, and a lot of that has to do with inflation. On the other hand, if you're filing a joint tax return, married filing jointly, then your standard deduction is $25,100 in 2021, $25,900 in 2022. And if you're over 65, $27,250. The amount of the deduction, the standard deduction, is adjusted each year for changes in the consumer price index. So that's the inflation adjustment that is made every year. So standard deductions then are an amount that's allowed by the tax law. And this is if you don't need to itemize your deductions, or you don't want to itemize your deductions, or your itemized deductions are just too small. If that's the case, then go with the standard deduction. All right, now, let's say on the other hand, maybe you want to consider itemized deductions. All right, so itemized deductions would include medical expenses more than 10% of adjusted gross income. So remember, I mentioned the adjusted gross income before is used for calculating different things, and there's an example of it. So if you have medical expenses that are larger than 10% of your adjusted gross income, then you can deduct them, anything over the 10%. So that's one category. Next, you have state taxes, but only property taxes and either income or sales taxes limited to $10,000. So long story short here is that the state taxes, they could be taxes that you paid as part of your income. There may be property taxes that could be, say, for real estate. Usually, though, the municipalities will allow that. So, so this is also a possibility for you. So you look at your amount of medical expenses, you look at your state taxes and local taxes. You next look at your interest on mortgage for up to 2 personal residences. So you figure the bank will send you a statement at the end of the year, tell you how much interest that you have been able to deduct. So that's included. All right, so you take your total medical expenses, your total state taxes, your interest on your mortgage for up to 2 personal residences. Remember, it's the interest on your mortgage, not the principal and interest, just the interest. You can then add to that any charitable contributions you make. So it's got to be to an approved organization known as a 501c3 organization. That's an approved IRS charitable organization. You can't deduct a contribution to a person. It has to be to a charitable entity. So and a single contribution, if you have an amount that you're donating, it's over $250, you have to have a letter from the organization stating that you received no services. It's got to be a pure contribution. So if you give something to a charity and they give something to you in return, well, whatever the value of that thing is that was that you received from the charity has to be deducted from your contribution. So you can only deduct actually what you really gave to the charity, essentially the net amount that you gave to the charity. Finally, there are miscellaneous items. There are any number of these things, but one of them, for example, is if you have business expenses, if you're self-employed, anything over 2% of your adjusted gross income, there's that number again, that adjusted gross income, anything over 2% would be in there. Now, these items, though, are not deductible currently in 2018 to 2025, but in other years, they are deductible. So again, you have your adjusted gross income. You can take your standard deduction, but if you have itemized deductions that are larger than your, and this is the total of these itemized deductions, not just one category, but the total of all of your itemized deductions. If the total is larger than your standard deduction, then you can then write off from your income the itemized deductions. So let me give you just a real quick way to look at this. Let's say, for example, you have $10,000 standard deduction and $12,000 of itemized deductions. You can deduct $12,000 from your adjusted gross income. On the other hand, if you have $8,000 of itemized deductions and the standard deduction is $10,000, then what you do in a case like that is, because the standard deduction is larger than your itemized deductions, then deduct the standard deduction, which in this example was $10,000. Okay. Charitable deductions. So these deductions are they're in a number of different ways. They are, again, for the charity. They you can make a charitable contribution to the charity or to a charitable trust that's managed by an investment fund. There are not any number of things, but the thing of it is that you're limited to the amount of charitable deductions. It can be no more than, if it's a public charity, no more than 60% of your adjusted gross income. Okay, so that's, again, there's the adjusted gross income number again. It just keeps coming back. There is something called a qualified charitable distribution from an IRA. It's really kind of beyond the scope of this class. I'll just tell you very briefly that if you are over the age of 70 and a half, and you are required to make distributions from your personal retirement account, you can actually send the money from your personal retirement account directly to a charity. There's certain limits that you have to follow with that. I'm not going to say that you should worry about this for right now. Probably by the time that you retire, the laws are going to change anyway. But nevertheless, it is something that's possible, but you won't have to worry about it for this class. Okay, so there are items that have been deductible in the past that are not deductible, at least for the next, at least through 2025. So if you suffer a loss, a casualty loss, you have something happens to your house, and you have to pay money out of pocket, or there's a disaster, any of these kind of things, moving expenses. If you move, that cost could be considered as an itemized deduction. There are other items that are listed on here. These are items that are not allowed right now, but they have been in the past and may indeed be allowed after 2025. So this is just for your information. So if you have a business, there are, and it's actually, again, beyond the scope of this class, you can certainly read up on what these are. You can deduct, again, certain types of expenses from income if it's a business, but again, there are limitations. Here, I would not worry too much about that for the purpose of this class. Now, there's also something called a tax credit. So credits are dollar for dollar reduction in tax. The value is the amount of the credit. All right, so a deduction reduces your taxable income. So the value of a deduction is whatever the deduction is times your tax rate. But a credit is an amount that you get back that offsets exactly $1 of tax that you pay. A deduction just reduces your income tax. A credit actually gives you money back that you would otherwise pay in taxes. So there are some credits here that we talk about. Again, these may or may not apply to you. Now, also there are some credits that will be refundable to you. Some of them will not be. So a refundable tax credit will give you a tax refund if the credit is larger than your income tax. So if I owe $2,000 of taxes, but I have a refundable tax credit of $3,000, the $3,000 is larger than what I owe of $2,000. So I'm going to get an additional $1,000 back from the government. However, a non-refundable tax credit will only reduce your income tax to zero. It will not give you a tax refund. Okay, so for example, only $1,400 of the $2,000 child tax credit is refundable. And the $500 credit for qualifying dependent is not qualifying child, is non-refundable. So that is, again, the child tax credit. We can discuss that a little bit further, but I'm not going to have you worry too much about that. But you should know the difference between a refundable and a non-refundable credit. So as I mentioned previously, when you are working, the years ago when they first started income tax, people had to pay the tax at the end of the year or whatever. And of course, people being who they are, they didn't put money aside to pay the tax. So what happened was people were starting to go into heavy debt because they just kept spending the money that they should have been saving some of that to put away for taxes. So that's why they started withholding tax. So the employer is required to withhold income tax from your salary. And also it's possible that banks and other financial institutions, they may withhold tax as well from any money that they give back to you, anything in the form of interest income. Or if it's something like in a retirement fund that is taxable, they may also withhold tax in a case like that. So if you are self-employed, then what happens is your income is not subject to withholding because you're not working for somebody, you're self-employed. But what that means is every quarter, every 3 months, you've got to send money to the IRS to cover your potential tax. All right, so that's self-employment income. You have to do what they call file quarterly. And finally, remember, a tax refund is tax owed less tax that's withheld. So if you have too much money withheld, then you are going to get a tax refund. All right, I'm going to stop here right now, and we're going to do one more video where we talk about an actual tax return. All right, so we'll see you at the next video.